affected. So I think really the
What's
question
up,
is
guys?
December, and by December we'll have more data. I guess one
I'm on
more
a laptop,
employment
had to
report,
do a
two
whole new
more
setup.
inflation reports, and lots of other data,
So,
and we'll make a decision
sorry, I'm
as
late.
we get to December.
Gina Smilik from the New York Times. Thanks for taking our questions, Chair Powell. When it comes to December, what will you be looking at specifically as you try to make that decision? And then as of the Fed's economic projections in September, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point, or has that shifted? And if it shifted at all, can you give a little bit of detail as to why?
You know, we don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I will just say for December, we're going to be, again, at every meeting, we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points. And we're asking ourselves, is that where we need to be? You know that we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. We're trying to be on a middle path where we can maintain the strength in the labor market while also enabling further progress on inflation. We think that's where we are, but that's the question we're going to be asking in September and in other meetings. And again, I can't really update you on the committee's thinking because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, I'm going to wait. We're going to wait and see how things come in December. I mean, it's just. I would put it this way: we're on a path to a more neutral stance, and that's very much what we're on. That has not changed at all since September, you know, we're just going to have to see where the data lead us. We have, you know, a whole 6 weeks of data to look at to make that decision in December. Obviously, I'm not ruling it out or in, but you know, I would say, I would say that, you know, again, we didn't update the SEP, so I'm not going to characterize, you know, where the committee would be.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate, explain a little bit the 2 changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress, and in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation in the last 3 months?
Not really, no. So let me tell you what we were thinking. So the test of gaining further confidence was our test for the first rate cut, right? And so we met that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about. It's not meant to send a signal. Neither of those is meant to send a further signal. And saying further progress, it becomes a test. We don't want to be. We don't think it's a good time to be doing a lot of forward guidance. You know, there's a fair amount of uncertainty in that. In what I've said, the path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the point is to find that. To find the right pace and the right destination as we go.
1 second.
And I think there's a fair amount of uncertainty about that. And you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
Steve Leisman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates, and is that are rising deficits a concern to you?
So we don't comment on fiscal policy, and again, I don't have a lot more to say on what's driving bond yields. In terms of policy changes, though, let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outlines, so we'd start to model it. And then we'd wait, and then at a certain point, the staff would brief the FOMC and say, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes.
This is the
on various
impact
parts
on
of the
my
economy.
portfolio.
So we try to get smart on that, and then the law actually passes. And you'd start to put it. You probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model, along with a million other things. So we have a very large economy. Many things are affecting it at any given time.
420.
And a law change of some kind would go in there, but it would go in. But it would it's a process that takes some time.
skip it here.
Clearly, the legislative process takes a lot of time. And of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect, and the overall effect on the economy at any given time? So I think that's a process that takes a lot of time and that we go through all the time with every administration, constantly. And this will be no different. But right now there's nothing to model right now. It's such an early stage. We don't know what the policies are, and once we know what they are, we won't have a sense of when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time, and it will be very much regular order when we do that.
If I could just follow up on Nick's question, are the current rates something you feel like you need to lean against, in that they go against the direction of policy by adding restriction to the economy, or do you just take them as a given and perhaps a signal that you should do less?
I just think the first question is, how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions, only to find 3 weeks later the 10-year was 50 basis points lower. So it's material changes in financial conditions that last, that are persistent, that really matter, and we don't know that about these. What we've seen so far, we're watching it, we're reading, we're doing the decompositions and reading others, but right now, it's not a major factor in how we're thinking about things.
Thank you, Chris Rugaber at Associated Press. You mentioned the positive economic data that we've seen since the September meeting, including the revisions to things like savings, higher GDP growth. We saw a stock market jump yesterday. That's renewed some of the questions about why do many cuts at all in this with this backdrop.
So you're right. As I mentioned, and as you mentioned, the latest economic data have been strong, and that's, of course, a great thing and highly welcome. But, of course, our mandate is maximum employment and price stability, and we think that even with today's cut, policy is still restrictive. We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal from its overheated state of 2 years ago and is now essentially in balance. It is continuing to cool, albeit at a modest rate, and we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Inflation has moved down a great deal from its highs of 2 years ago, and we judged, as I mentioned, that it's on a sustainable path back to 2%. So the job's not done on inflation. But if you look at those two things, we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress, and today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy stance, we can maintain strength in the labor market even as our policy stance enables further progress toward our inflation goal.
Great. And just to follow up, what might cause you to pause rate cuts in December? What kind of economic data would lead you to that path? Thank you.
So we haven't made any decision like that at all. But we're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves. So, for example, if we were to see the labor market deteriorating, we'd be prepared to move more quickly. Alternatively, as we approach levels that are plausibly neutral or close to neutral, it may turn out to be appropriate to slow the pace at which we're dialing back restriction. Again, haven't made any decisions about that, but that's certainly a possibility. If you can think of it as similar to what we do with asset with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down. And so we're thinking about it that way, but it's something that we're just beginning to think about.
Edward.
Thanks, Chair Powell. So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12-month. So we look at all of them, right? But if you look at 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we also look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand, the January reading certainly looks like an example of residual seasonality, so that we saw last year. So when that falls out of the 12-month calculation in February, we should see a thing down. So it'll literally be a bump up and then down. We understand that. Overall, you see the progress on inflation, and you also look at the economy and you say, what is the inflation story now? Where is it coming from? So I point to a couple of things. One is
nothing's moving. It's all pretty stable.
Non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very tight economy. What is the story about inflation? You see that catch-up inflation also in insurance and several other areas. So you're seeing we're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact, and it won't be 1 or 2 really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So you're quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully, but we do see maintaining strength there. And so we think that the right way to find neutral, if you will, is carefully, patiently. Again, that's not meant to have a specific meaning, other than to the extent the economy remains strong, we have the ability to take advantage of that as we try to navigate that middle path between the two risks.
A lot of volume coming in.
Hi, Chair Powell. Craig Torres from Bloomberg.
The bold ratio
2
is up on
questions
Q.
today. Did you learn anything about what Americans think about the economy from the election results? First question. Second question. I want to talk about some labor market indicators, and I do so with great respect for your attentiveness to the maximum employment side of the mandate, Chair Powell. So the unemployment rate has been at 4% or higher for 6 months. One of the broadest measures of unemployment is up about 0.5 point from a year ago. Compensation gains are sliding back. The quits rate, a signal of labor market dynamism, has been heading down to that bad neighborhood of the 20 teens. So you have put a marker at Jackson Hole saying any further cooling is unwelcome. It is cooling generally a little bit further. So at what point do we reach what you would describe as a shortfall from maximum employment? Thank you.
Sure. So on your first question, I'm not going to talk about anything that relates directly or indirectly to the election. On the second one,
He's not going to get political on
you're,
this. We
you know,
appreciate
this is
that.
the great question, and so one we think about all the time. So I'll just say a couple things. You know, there's nothing really surprising here. What we know is that the unemployment rate is low. We also know that it's come down significantly, moved up significantly.
Sorry, man. You
From
fudged these
a year or so ago.
numbers.
So we've
I
seen
know
a big
you.
change upward in unemployment.
They just
Sometimes that
manipulate.
has
Half
meant
those numbers are
bad
government
things.
jobs.
So
We just
far,
resolve it, or
it doesn't appear to be. It appears that I wouldn't say that the labor market is fully stabilized,
When they change
because I do
after
think it's
that.
continuing to very gradually
Revisions.
cool.
That was
But it
revised.
seems to be in a good place, and
Chairman
our
Nicholas.
policy, of course, is designed to keep it in that good place, to maintain the strength in the labor market, while also enabling further progress on inflation. You know, you mentioned a bunch of
manipulation
of indicators, and you're right. You know, the openings to unemployment rate is back to a normal level. I would characterize it more broadly as normalizing. You mentioned wages. Wages are still running just a bit above where they would need to be consistent with 2% inflation, unless productivity is going to remain at this high level. If we see productivity, you know, more sustainably at these high levels, then that would sustain higher wage gains. So I would say, in fact, you could say it the other way, that wage increases are now consistent with 2% inflation, given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer-term trend. That has always been the case for 50 years. But, you know, it may be that we're now 5 years, if you look at the NIPA revisions that came out a month ago, we're 5 years into a nice set of productivity readings, which are sustained and very healthy. But overall, it's a good labor market. We could talk about 20 different data series. We'll be looking at all of them, of course. You know, we don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
Victoria. Hi, Victoria Guido with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
That's
Can you
great.
follow up on, do you
Sorry,
think
I got
that
some orders
legally
coming through.
you're not
I don't know if
required
you
to
can hear
leave?
that.
No.
You can't hear it? Okay, good. That'd be annoying.
Michael McKee from Bloomberg Radio and Television. You talk a lot about what the data are telling you and how you are dependent on the data, but in terms of
There's a lot of
forward-looking
orders coming in.
assessments of the economy, what are you hearing from CEOs or other officials around the country? What did you hear today from
Moving
the
average
regional
price
bank
overs.
presidents about what companies and consumers think about where the economy is going from here rather than looking backwards? And does that match up with what your forecasts have been and what you think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talk to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much a discussion topic in their worlds, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. People feel good about where the economy is. Demand is obviously pretty strong, And you're seeing what 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with strong growth, a strong labor market, inflation coming down. We're really performing better than any of our global peers. I think that is reflected in what you hear from what I hear people hear from CEOs. I don't get to talk to a lot of CEOs in my job, but I hear what others summarize from those, and of course I hear the Reserve Bank presidents do a lot of that, and it's pretty constructive overall. Now, that's not to say there are areas of caution and things like that, but ultimately, overall, pretty positive.
It is dumping money into
To follow up the areas of caution, if there were black clouds on the horizon that you identified as something you're watching, what would they be?
I think it's things like clearly geopolitical risks around the world are elevated, and just as clearly they've had relatively little effect on the U.S. economy.
Hey, we're up like 1%.
Now, that can change through the price of oil or otherwise, but people talk about those as something that's on the horizon all the time. But ultimately, if you look at the U.S. economy, its performance has been very good, and that's what we hear from business people, and expectation that will continue. If anything, people feel next year. I've heard this from several people that next year could even be stronger than this year.
I'll try to mute those trade alerts on future streams.
Hi, it's Andrew Ackerman with the Washington Post. I just wanted to follow up on the discussion earlier on fiscal policy. Your predecessors, Greenspan and Volcker, spoke up loudly when they thought large budget deficits endangered economic or financial stability. Will you do that too? And right now we're in a period of full employment. We have large budget deficits and debt at historic highs that are and rising.
Calls for sale.
Is that something
nobody's buying them
against?
So I have said
it's a great
many
price.
times,
You should buy my
no more,
call.
no less than what the predecessors you mentioned have said. And what that is that the U.S. federal government's fiscal path, fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable. And we see that in, you've got a very large deficit at
I hope that call does well
full
for you.
employment, and that's expected to continue.
Actually, I hope it goes to zero.
It's important that we, that to be dealt with. It is ultimately a threat to the economy. Now, I can say that. I don't have oversight. We don't have oversight over fiscal policy. I've said it on many occasions, just said it again.
It's a zero-sum game here.
Okay, thank you. I guess the other question is to follow up on Victoria's question. Do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a
Mr.
president
Powell. We have a good thing
demoting
going
at
here.
will any of the other governors with leadership positions?
We like them.
Not permitted under the law.
Hey, there you
Not
go.
what?
Not permitted under the law.
Thank you.
Jeez, don't buckle.
Courtney Brown from Axios. In response to Howard's question, you said it wasn't an ideal time to give forward guidance because of the economic uncertainties. Can you lay out what some of those uncertainties are and whether or not it includes some of the proposals that the president-elect has put out on the campaign trail? Tariffs, for instance?
No, I was not referring to the new administration's policies at all, nor will I today. What I'm just saying is, as we look ahead,
Shout out to our friends.
we
in
know,
Cheddar
and I mentioned this in my statement, that
we like them.
that the risks are two-sided. I guess I should start by saying that we think
$350
that the
million,
economy and we think our
$500
policy
million, a
are
half a
both
billion.
in a
In
very
just
good
calls.
place.
That's not
Very
direct
good
calls.
place.
That's just calls.
And
they're buying the December 20
but
calls.
as you look forward,
in the money.
you say, what are the risks? And
But
one risk is that we would
Nvidia's
move
gotta
too
go up.
quickly and find ourselves
These were both
having
like
moved too
opening too.
quickly, and inflation comes back, and we lost our chance to get inflation back to 2%. So we have to avoid that risk. And
Powerful buyer on
to
Nvidia.
avoid that risk,
Powerful
that means you
buyer.
want to move carefully. The other risk is that we move too slowly, and that we allow the labor market to weaken too much and do unnecessary damage to the labor market and to people's working lives.
sell my puts.
That says don't get behind the curve. So these are these two things are the two risks that we have to manage, and so we're in the middle there. We try to be in the middle and deal with manage both of those. Again, the idea is to maintain support the strength we have in the labor market and in the economy, but also with somewhat less restrictive but still restrictive policy,
I'll tell you what all these
enable
groups are.
further progress toward our 2% inflation
They're
goal.
just
There-
buying
so there's,
auxiliary. I am
this is the
buying
thing, we're
auxiliary.
meeting by meeting, we're going to be making our assessment of what the right path is. It's not as important, the precise timing of these things is not as important as the overall arc of them. And the arc of them is to move from where we are now to a sense of neutral, a more neutral policy. We don't know exactly where that is. We only know it by its works. We're pretty sure it's below where we are now. But as we move further, there will be more uncertainty about where that is, and we're going to move carefully as this goes on, so that we can increase the chances that we will get it right.
See what auxiliary is doing.
Thank you, Chair Powell. Simon Rabinovich with The Economist. I know you don't want to share your decomposition of bond yields, but if you look at the break-evens, it is clear that longer-term inflation expectations do seem to have risen, up at about 2.5%, for example, on the 5-year. That's up half a point from when you cut in September. Do you have any concern at all
That's
that
the most premium
longer-term
coming into
inflation
the market today,
expectations
500
are
million in
de-anchoring,
NVIDIA.
or
Top
put another
NVIDIA.
way, are anchoring at a slightly higher level?
1.3 billion into calls,
Thanks.
200 million.
So
into
we
puts, very
would be
bullish.
concerned if we thought we saw
Strong.
longer-term inflation expectations anchoring at a higher level.
run
That's
through,
not
keep
what we're
going.
seeing. We're still seeing between surveys and market readings broadly consistent with, I looked at the 5-year earlier today, and it's probably moved, but it's just not,
Lots
it's
of
just
call by
it's
now
kind of
are,
right
oh,
where it's
geez,
been,
look,
and also
maybe
it's
I'll
pretty
put
close
that.
to consistent with 2% PCE inflation. So that's been a traditional one that we look at a lot. But overall, expectations seem to be, and really have throughout this, in a place that's consistent with 2% inflation. But you're right to say we watch that very carefully, and we will not allow inflation expectations to drift upward. But that's really why we reacted so sharply back in 2022 was to avoid that.
Sure, I'm better than that.
Hi,
That's
Chair
a risky
Powell,
call
Kelly
they
O'Grady,
bought.
CBS News. We just talked about what you've heard from business leaders on the economy, but many average Americans are still not feeling the strength of the economy in their wallets. So what's your message to them on when they might expect relief?
So you're right that we say the economy is performing well, and it is, but we also know that people are still feeling the effects of high prices, for example. And the world went through a global inflation shock, and inflation went up everywhere.
That was an
and
opening order.
it stays with you because the price level doesn't come back down.
Yeah.
So what that takes is it takes some
Not that
years
premiums
of real
are
wage
falling.
gains
Really
for
not
people
that
to feel better. And that's what we're trying to create, and I think we're well on the road to creating that. Inflation has come way down. The economy is still strong here. Wages are moving up, but at a sustainable level. So it's just, I think what needs to happen is happening, and for the most part has happened. But it'll be some time before people, regain their confidence and feel that. And we don't tell people how to feel about the economy. We completely respect what they're feeling. Those feelings are true. They're accurate. We don't question them. We respect them.
And just a quick follow-up. President-elect Trump has been critical of your performance. Any concern about his influence on the Fed's independence?
I'm not going to get into any of the political things here today, but thank you.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. What is your plan if we start to see stagflation?
So that's the whole plan is not to have stagflation, so we don't have to deal with it. So that is actually our plan. It's of course a very difficult thing because anything you do with interest rates will hurt one side or the other, either the inflation mandate or the employment mandate. I would just say that we've been able to see inflation come down a whole lot, much closer to our goal, without the kind of sharp increase in unemployment that has often accompanied programs of disinflation. So, knock on wood, we've gotten this far without seeing a real weakening in the labor market, and we believe we can complete the inflation task while also keeping the labor market strong. And that, of course, is exactly what we're trying to do.
Can you rule out an interest rate hike next year?
No, I wouldn't rule anything out or remain that far away, but that's certainly not our plan. I mean, our baseline expectation is that we'll continue to move gradually down towards neutral, that the economy will continue to grow at a healthy clip, and that the labor market will remain strong. If you look at our that will not change from the September SEP. You know, that is our baseline forecast, and
we're almost at SPY
short of some
600.
exogenous event, that will continue to be our forecast.
We won't get
for
there
the
today,
foreseeable
but
future.
maybe this week.
But ultimately, you know,
Maybe next
we're
week.
not in a world where we can afford to rule things out a full year in advance. There's just too much uncertainty in what we do.
They do like to sell it after he's done speaking, and he's trying to wrap up. I can feel it.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to go back to a comment that you had made about Americans being quite unhappy about the cumulative price level rises over the past few years, even though now inflation is back on a path to 2%. Would it be appropriate for the Fed to undershoot for a while on its inflation goal under the average inflation targeting regime, so people have a chance to catch up?
No, that's not the way our framework works. We're aiming for inflation at 2%. We did not think it would be appropriate to deliberately undershoot. And you know, part of the problem there is that low inflation can be a problem too, in a way. But that's not part of our framework, and it's not something we're going to be looking at in our framework review. Thank you very much.
All right. Happy Fed Day, everyone. Markets liked it. Now we'll see if we do a quick sell-off. Let me just hit pause on this. See if I got any commentary for you guys. So let's see what the market's doing. Generally, seems to like it. Basically, everything's up. Even bonds are up. So they're starting to load up risk. I've been talking about for a while on my channel that they are going to do a blow off top. I think it's happening now. This is it. Like it's beginning at least. IWM is basically at an all-time high. The small cap sector is rallying, and obviously high risk assets like Bitcoin are popping too. So we're deep into this market move. So basically what I think is going to happen is it's a post-Trump rally that's going to lead into a blow-off top around SPY 600. So here, basically, here now. They're going to start selling their longs, maybe 610, 620, something like that. And then they're going to sell it short because they like to double their money and make retail hold the bag by suckering them in with one of these candles. They like that candle. And so they're like, I'm missing it. I'm fearing missing out of it. Let me buy in. Meanwhile, this is just like algos pushing this number up. It's not even like real people. It's like retailers. I mean, first of all, I'm buying this because I'm following, traders that know what they're doing, and they're buying it as well. So I'm not saying that it's going to crash anytime soon. It could rally for a week or two, maybe a month. But, whether it's Q1 25 or tomorrow, they're going to sell it, and they're going to sell it hard. So like they're just waiting for a reason, but they can't really sell it until they get enough people to hold their bags for them. And basically they need exit liquidity from the retailers of the world. And so all the retirees, all the retirement funds, all of those got to pay for the bankers' big wins. And yeah, like this, we're not at euphoria yet. Euphoria happens when the bears are just weeping and everyone is rushing in because markets only go up. People get wiser over time, but I doubt they're that wise. So yeah, we're going to see this little puppy get all the way up, a lot higher than it is today. It's going to grind up to here and then sell to some level. And then probably end up at around 610, 620. I mean, we could just draw a fib and get a guesstimate of what's going on. I'm not like an amazing technician, but it's not like, you don't got to be a genius to do this stuff. So yeah, it's around that level, 615, 610, just depends on kind of where you draw it. That's just like a guess or whatever. So I think we're basically going to grind up here, and this is where everyone is going to get FOMO and rush in. They're going to poke it up a little bit further, and then they sell their longs, and they use that cash to sell it short. And that's when the real party can begin. I think they're going to get SPY below, 550 or whatever. They really do need a reason to do it. They can't just sell willy-nilly. So there's got to be a good reason to sell it. And we'll find one, like there'll be a war or a rumor of war. Something will happen that'll give them the excuse that they're looking for to sell it. But until that happens, it's a grind higher. So, basically I'm looking for whatever is going to reinflate. I basically missed a bunch of trades because I got liquidated on August 5th. So still rebuilding from that, maybe about halfway recovered, or infinitely not recovered if you consider the gains I would be enjoying had that one event not happened. But that's how it goes in trading. I mean, literally, like the whole game is so manipulated. It's so rigged. It's crazy. And if you're anyone who's anyone, you're fucked. You're so fucked. Like, they're going to fuck you for sure. They can just watch. First of all, everybody knows this kind of stuff. They front run all these orders or whatever. But like, they can target individual people. Like, people think markets can't be manipulated. No, they're the most manipulated. They've spent decades building tools to manipulate them better. Like, it's the most manipulated thing there is. And the Federal Reserve, they're part of the game. Like, all of the numbers that come out in these job reports, fucking hilarious. They're always revised to fit one. Basically, whoever is the enemy, we're going to liquidate them. And then after they get liquidated, that's when we're going to, do the real move or whatever. And they're just always trying to play that game. They want to stop out the shorts and then bring it down. Then they want to stop out the longs and then bring it up. They do it all the time. And so it's really hard to, you can just set it and forget it if you're a fucking boomer or whatever. I don't know. You could just set it and forget it if that's not what we're doing on my channel. On my channel, we're using margin, we're using options, we're using leverage, and we're going to figure this shit out. And I've said that since the beginning, because that's what the big boys do, and we want to play with them. And it takes a lot to be able to play with them. So, yeah, I guess that's my thoughts on markets. What would I do if I was trying to participate in this upside? We kind of missed it a little bit. You could buy every dip in Nvidia. That's what they're doing. We could just look and see that they're doing that. Let's go back to Nvidia. Look at that. It's incredible premium coming in. It's $500 million. That's not normal. That's not normal at all. And so they wouldn't just be buying this if they didn't know something, they know something. And even if they don't know anything, this is the type of order that's going to actually move the market, because as it gets closer to the expiry period, that's in the money. They're going to have to come up with those shares somehow. So we could do a quick check. Yeah, Energy Transfer's got some flow. Interesting. Now, interesting. Tesla's going to have a hard time breaching 300. That's what it wants to do. It looks like they're monetizing crypto and stuff to just buy up more Nvidia. Mastercoin, Pinduoduo, Square. Yeah, they're selling a bunch of those Chinese names and stuff like that. I thought they were buying China today, but DJD. That's funny. Trump's getting sold today. Let's just do one check and see if any giant dark pools happen. 1.2 billion at 591. That's got to be a sell, right? Okay, well, that's all I got for you guys. Happy Fed Day. Hope you're